Hello everyone, I am not a professional financial advisor. All the advice and information in this video are for entertainment purposes only, so do your own research and seek professional guidance as needed. Is a 401k the same as a pension? If the stock market tanks, does that affect my 401k? Who the heck is Roth and what does he do with my IRA? Huh. Is math related to science? How's it going, guys? It's Lucero Boy with some millennial investing. Aside from millennials loving avocado toast and blaming boomers for our uncertain future, the one thing we don't understand is how to invest. This applies to all beginners, and it's stuff that I wish I knew when I was 18. The stock market isn't just some place on Wall Street where rich people go to complain. In reality, at least 50% of the US population has stocks. For far too long, I thought a 401k was kind of like a social security. You know, just some place your paycheck went for retirement benefits. Well, spoiler, I was completely wrong. If you have any retirement account with an employer, you're already investing in the stock market. Today we're going to go over the basics in investing, types of investment goals, investment accounts, how to open an account, and what to invest in. It would take forever to dive into every little detail, but we're going to take a step into the shallow end. I hope to give you enough information that you'll be confident in starting your financial journey. So make yourself comfortable, open some memes up on another tab, and log into Facebook. Wait, is Facebook for boomers now? Because this is going to be a dense video. Whew. So before we start, we need to make sure the basics are in order. So first, you need to have a budget. I did a walkthrough of budget planning in my last video. You need to have a structured flow of your income or it might just disappear on you. Number 2, have savings of at least 3 to 6 months of expenses in a high yield savings account. This is so you can weather any storm in the stock market. When you invest, consider that money gone. Don't expect to get a return for it for at least 10 to maybe even 20 years. Any emergencies should be covered by this emergency fund. And number 3, pay off any high interest debt that is above 5%. Unless that debt is cash flowing like some rental property, the average return of the stock market is 7%, so factoring in taxes, expenses, and other fees, you're probably better off paying off that 5% interest. Now think about the goals you want to invest in. Depending on the size of it, the time period of completion, and its urgency, this will guide you on your investing strategy. Some goals might be a dependent's college tuition, a house down payment, a new car, retirement, fast wealth building, or a passive dividend income. The key characteristics of investment accounts to keep in mind are how liquid or how easily accessible the money is. Limitations such as what you can invest in, how much you can contribute every year, expenses such as when and how is the account taxed, fees for maintenance or management. Your investment strategy. Do you want to be passive? Do you want to day trade? Do you want to invest in only growth stocks? As you continue on in this video, use these qualities to determine how you want to invest. So first we'll start off with the employee offered tax advantaged accounts. These are the 401k, solo 401k, 403b, 457, and the simple IRA. Each one has slight nuances, but let's do a brief summary. Okay, so let's go over the pros of these accounts. So number 1, these accounts are tax deferred. Contributions to these accounts are pre-tax and decrease the impact of tax on your income. Number 2, the employer match, aka free money. Employers will match your contribution to your retirement accounts. For example, the employer may offer 50% deferrals up to 6%. This means if you contribute 6% or more of your income, the employer will contribute their money equal to 3% of your income. Some employers will match dollar for dollar no matter the amount. Requirements for maximizing this benefit is unique to each scenario. Let's go over the cons. Number 1, contribution limits. This means you're only allowed to contribute a certain amount every year. This could be $13,000, $19,000, up to $57,000 depending on the specific account. Number 2, account terms. Because the employer offers this account, there are certain terms that you need to agree to. These terms include maintenance fees, minimum required balance, or deposits. Unfortunately, you must accept these terms, but at least you're getting a company match. 3, investment limitations. These retirement accounts limit you to what you can invest in. Some plans will allow you to invest in their own index or mutual funds. This is a 401k I have with Fidelity. As you can see, I can choose to manage my own account, but I can only pick from a basket of funds. These funds are typically structured based on risk tolerance. As you get older, your money is moved into less volatile funds, such as bonds. Number 4, early withdrawal penalty. Except for the 457b, there's a penalty for withdrawing from these accounts before 59.5 years old. There is a way to withdraw penalty-free with a Roth IRA conversion ladder. Basically, transferring employer account assets to an IRA and then to a Roth IRA allows you to withdraw the money penalty-free, but this is a 5-year process. And number 5, taxed as income. These accounts are tax deferred, meaning contributions come from pre-tax income. When you do withdraw in retirement, you have to pay income tax on it. For a majority of people, this is the best way to invest. The employer match and tax-deferred qualities are a big bonus. Downsides are investment choice, liquidity, and contribution limit. The next group of tax-deferred accounts are the individual retirement accounts or IRAs. These are accounts you open up yourself without an employer. These are the IRA and self-directed IRA. Both these IRAs have contribution limits of $6,000 to $7,000. They are similar to employer accounts, but since you contribute on your own, there is no employer match. The difference between the IRA and the self-directed IRA is that the self-directed IRA has more flexibility in your investments. You can even invest in cryptocurrencies. Pros. Number 1, tax deferred, just like the previous accounts. And number 2, investment freedom. Since these are accounts you open up for yourself, you can select what conditions you will accept. Overall, you have more options in what you want to invest in and what fees you will pay. So cons. Number 1, contribution limits. The contribution limit is even less than the employer accounts. Number 2, no employer match. Number 3, early withdrawal penalty before 59.5. And number 4, withdrawals are also taxed as income at retirement. Not as many benefits as the employer offered accounts, but what people will do is have an employer offered account and an individual retirement account as well to maximize their retirement contribution limit. Now we have the tax-free account, the Roth IRA. You contribute to Roth IRA with post-tax income, but you are not taxed when you withdraw from the account. So pros. Number 1, at retirement, withdrawals are not taxed. Number 2, contributions to your Roth IRA can be withdrawn at any time. Any growth can be withdrawn penalty-free after retirement. This is where the Roth IRA laddering comes in. Rolling over an IRA to a Roth IRA counts as a contribution, but you must pay income tax and wait 5 years before withdrawing. Number 3, investing freedom. So since this is an account you open up yourself, the terms and conditions are totally up to you. The cons. Number 1, contribution limit. You only have a limit of $6,000 to $7,000 in contributions every year. 2, contributions are not tax deductible. As with the previous accounts, you would contribute before you are taxed. With the Roth IRA, your money is taxed first and then put into the Roth IRA. And number 3, the growth is only accessible after 59.5 years old. The Roth IRA can be a great account to bridge early retirement and your retirement accounts. People that follow the FIRE movement will use the tax advantage accounts to fund their early retirement by planning their financial needs 5 years in advance. Also, the Roth IRA protects you from potential tax increases in the future. Lastly, a bonus account is the health savings account or the HSA. To qualify for the HSA, you must have a high deductible health insurance plan. It means you pay more out of pocket before insurance coverage comes in, but your premium payments are much lower. These plans are best for the young and healthy who typically only go for checkups and preventive care. Pros. Number 1, your contributions are tax deductible. And number 2, you can use the balance from the HSA for any health-related expenses at any time, tax and penalty free. Cons. Number 1, your contribution limit is between $3,000 and $7,000. Number 2, you must meet a certain criteria before you can invest with the account. These are conditions set by the bank associated with your HSA. Number 3, early withdrawal penalty. Like with the other retirement accounts, if you withdraw before 59.5, there is a penalty. And number 4, it is taxed as income when withdrawn in retirement. Remember, medical expenses are still tax-free. The HSA is a great way to save on your insurance plan premiums while still having a safety net. What I do is I put the money that I save from having the cheaper premiums into the HSA. This way, if a medical emergency does arise, I will have a cushion and not feel like I'm losing money on premiums when I'm in good health. Okay, that was a lot of information. Originally, I was going to explain every single account. But for a beginner, I think this is a great place to start. Alright, so let's do a brief recap. In our basket of tax-advantaged accounts, we have the employer-offered accounts, individual accounts, Roth IRA, and the HSA. The employer-offered accounts have employer matches. Employer-offered accounts and individual accounts are tax-deferred. Roth IRA is tax-free. The HSA is tax-deferred and tax-free on medical expenses. All accounts have a contribution limit. All accounts have an early withdrawal penalty. Exception is HSA medical expenses and Roth contribution withdrawal. You should have one of these accounts. After learning about the characteristics of each account and if they are optimal for your long-term goals, consider contributing more to them. These tax-advantaged accounts are great for investing for a dependent's college tuition, your retirement, or just overall wealth building. I also recommend opening a no-fee IRA and Roth IRA account to supplement your employer's account, and so you can also take advantage of the Roth IRA laddering if needed. If your goals are short-term and on a smaller scale, then a taxable account, high-interest savings account, or a certificate of deposit may be a better place to park your money in the meantime. Finally, the taxable accounts. These accounts trade the benefits of the tax-advantaged accounts for freedom and liquidity instead. So here are the pros. Number 1, no contribution limit. Number 2, withdraw. anytime. And number 3, open an account with any bank or broker on your terms. All right, the cons. Number 1, you're going to get taxed. You'll be taxed on short-term gains and long-term gains. These are gains you get from selling a stock previously bought at a cheaper price at a higher price. And 2, any dividends you receive are taxed as income. Objectively, most people's money will go further in a tax advantage account. If you want to day trade, swing trade, or grow an accessible passive income, then you'll need to use a taxable account. So I gave you a bunch of information of all the accounts that you can invest in. But now your question is, how should I go about moving my money? If you want to focus on a foundation of wealth building, this is the order you should allocate your money. Number 1, have an emergency fund. 2, achieve full employer match on your retirement contribution, which is an instant return on your investment. Number 3, pay off high interest debt such as on credit cards. This may sometimes be switched with 2 depending on your financial situation. When you're done with credit card debts, then move on to debts that are higher than 5%. Number 4, max out HSA if you qualify. Number 5, max out an IRA. If you expect to be in a higher tax bracket in retirement, a Roth IRA would be better than an IRA. Number 6, max out 401k contribution. Number 7, pay off debt lower than 3%. Number 8, invest in a taxable account. Number 9, pay off mortgage. If it's long-term and low interest, your money will have a better return in the stock market that yields around 7%. This isn't a definitive order. It is just most likely the best way to wealth build for a majority of people. If you want to be an active trader, build a passive income in rental property or in stocks, your priorities will be different. For example, I want to make a passive income with dividend investments. I have no debt and very little expenses, so my priorities are a bit different. I have an emergency fund. I have met the full company match, to the point if I were to contribute more, it wouldn't increase the match. I only contribute my premium savings to my HSA. I maxed out my Roth IRA for 2019 and 2020. Then I invest in a taxable account. The money I am investing is money that I would be using for expenses if I did live on my own, such as rent, phone, electric, etc. I like to see it as this is money that I shouldn't have. And that's why it goes directly into wealth building. I will acknowledge that my money would probably go further in a tax advantage account, but the freedom and liquidity offered by a taxable account is more appealing to me right now. Not everyone can get into investing in a taxable account. Some maybe are still building their emergency fund, but that's okay. Realizing your financial success is way more important than 3 dinners out per week, the new iPhone, or the artisan coffee every morning is the first step towards independence and your financial journey. So if you are ready to invest towards your goals, let's quickly go over how to open an account. There are many brokers and banks you can open an account with. Here are some of them: M1 Finance, Robinhood, Webull, Acorns, Fidelity, and Vanguard. I personally currently use M1 Finance and a Fidelity account. M1 Finance is a robo-advisor and is completely free to use. It's fully automated and it's easy to set and forget. You can set up a portfolio and allocate a certain percent distribution to your stocks. Whenever you deposit, it will automatically set up trades and fulfill your orders until your funds are distributed proportionally. It trades with fractional shares, so even if a stock is $1,000, you can still get a fraction of it for a couple dollars. The downside is the lack of control on specific trades. You can set buys or sells and it will give you an estimate on the cost. They maintain a free trading platform by only trading at specific times. If you want to be a day trader, a swing trader, or actively manage your account positions, this is the best platform for you. Robinhood is a great platform to get an introduction to how stock trading works. It is also completely free and interface is easy to use. They recently began rolling out fractional shares as well. It is possible to day trade, but you are subject to the pattern day trading rule, which limits day trading unless you have a $25,000 balance. Fidelity is great for any general investing needs, and it is well established. Overall, they have great customer service. They offer robo-advisors, actively managed accounts, and have recently started free trading and begun fractional shares as well. Unfortunately, the interface is not as user-friendly as the previous platforms. Acorns is another robo-advisor. I only recommend this to people who have a hard time budgeting for investments. This forces you to invest by rounding to the nearest dollar. But there are many fees for this service that are free with many other platforms. If you put in the time, you could set up the same system on M1 Finance. For example, I set up a budget so that I can confidently deposit $480.77 every week into M1 Finance, which then gets automatically invested. Any dividends I receive are also reinvested. So down in the description, I've dropped referral links to the accounts that I use. If you're going to open an account, you might as well get something for free, and I get a reward as well when you use my link. Before opening an account, look into what kind of fees you expect to pay. There are sometimes maintenance fees and fees on trading. Many mainstream platforms are completely free now though. Alright, so you pick the account you want to invest in and you pick the broker you want to make your account in. And now, what are you going to invest in? For the majority of people, index funds is the best way to go. Index funds seek to follow market performance in a specific niche. There are many index funds that follow bonds, property, energy, retail, and many others. For example, the S&P 500 is a basket of the 500 largest trading US companies. Having a share of the S&P 500 means you have a share of all 500 companies. It's a great way to diversify your account with little effort and very low fees. A disclaimer though, index funds follow the market, so don't expect huge gains and expect it to fall whenever the market turns bearish. However, you should still be confident in index funds. A 20-year position in the S&P 500 has never had a negative return. If you invest consistently and hold long term, you will come out ahead. You can invest in mutual funds as well. They have the same idea as index funds, but they're more actively managed. They promise better performance, but the fees are high enough for me to discourage people from buying them. I personally don't recommend day trading, swing trading, or speculative trading. I won't stop you from investing in specific growth stocks. It's more risky, but the reward is much greater. If you do invest in specific stocks, invest in companies that you know will be bigger in the future. Companies that you personally have confidence in. There are ways to value these stocks, but it involves more analysis. I still do believe that index fund investing is the best overall for everybody. I know this was a dense video. Hopefully you learned something that you had no clue about before. My aim is to help you build confidence in investing and taking your first step on your financial journey. Honestly, I'm learning too, and the way I like to put it is that I'm only about like an hour ahead of you guys in YouTube videos. Originally, I thought, oh, this wasn't going to be a hard video, but then the more I learned, the more I dug deeper, the more I needed to share to get the best overall picture. Remember, we're all in this financial journey together, so if you want to stay on it with me, subscribe, and I'll see you guys next time. Fidelity is a great... says income when withdrawn on the stock market on annual. I think I'm done. I don't know what else. Stop.